Hey everyone, gold just crossed $5,296 an ounce, and the biggest banks on Wall Street are quietly whispering a number that would have sounded absolutely insane just 12 months ago. $6,300. That's not a fringe prediction from some gold bug on the internet. That's Wells Fargo, that's JP Morgan, that's Goldman Sachs. These are the same institutions that move billions in and out of markets every single day, and right now, they're all pointing in the same direction. So today, we're going to break it all down. Where gold is right now, how it got here, what the data is telling us, what the banks are forecasting, and most importantly, what comes next, and whether this bull run still has fuel left in the tank. Let's get into it. Let's start with the raw numbers, because they're almost hard to believe if you haven't been watching. As of March 1st, 2026, gold is trading at approximately $5,296 per ounce. The daily range today has been $5,182 to $5,299. The previous close was $5,194. That means gold is up nearly 2% in a single session. And when you zoom out, the story gets even more remarkable. 1 year ago, gold was sitting at around $2,833 an ounce. That means in just 12 months, gold has nearly doubled in value. Think about that. 12 months. If you had put $10,000 into gold at this time last year, you'd be looking at close to $20,000 today. That's not some speculative crypto trade. That's the yellow metal, the oldest store of value in human history, delivering returns that rival tech stocks in their best years. But the ride has not been smooth. On January 29, 2026, gold reached an all-time high of $5,595.42, and then, almost overnight, it crashed. Within days, it collapsed all the way down to $4,401, a 9% single-day drop, the steepest one-day fall in gold since 1983. Margin calls started firing across trading desks. Forced liquidations triggered a cascade. People who had levered up on the rally got wiped out in hours. So what caused that spike and crash? In short, it was a perfect cocktail. Trump's inauguration kicked off a wave of policy uncertainty. Tariff threats rattled global trade. The US dollar started weakening. Geopolitical tensions kept investors on edge. And suddenly, everyone wanted gold at the same time, driving the price to an all-time high in a matter of weeks. Then, stronger than expected US employment data hit the wire, and traders who had piled in at the top rushed for the exits simultaneously. Classic blow-off-top behavior. Now, price action is one thing, but what actually drives gold at a structural level? Because if we want to understand where it's going, we need to understand the engine underneath the hood. The first and biggest driver right now is central bank buying. In 2025, the world's central banks collectively purchased 863 tons of gold. That is a staggering number. These aren't retail investors chasing a trend. These are governments and sovereign wealth funds making long-term strategic decisions about their reserves. They're diversifying away from US dollars. They're hedging against geopolitical risk, and they're doing it at scale. The second driver is ETF inflows. After a couple of years where institutional money was relatively quiet on gold, it's back in a big way. JP Morgan is projecting 250 tons of inflows into gold ETFs in 2026 alone. When institutional money pours into gold ETFs, it creates sustained buying pressure that can support and lift prices for months at a time. The third driver is the US dollar, and this one is subtle but crucial. Gold and the dollar have an inverse relationship. When the dollar weakens, gold typically rises, because gold is priced in dollars and becomes cheaper for international buyers. Right now, the dollar is under pressure. Why? Because the Trump administration's trade policies, tariff announcements, and unconventional governance style are creating uncertainty about the U.S. economic outlook. And that uncertainty is bleeding into the currency. Then there's the debt. The U.S. national debt has now grown to $38 trillion, the largest in the world. When you see numbers like that, and when you see the government still running massive deficits, investors start looking for things that governments cannot print. Things like gold. Historically, when fiat currency credibility is questioned, gold is where money runs. And finally, there's global geopolitics. US-Iran nuclear talks are stalling. Tensions in Eastern Europe haven't fully resolved. Trade wars are escalating. Every time a geopolitical flashpoint heats up, investors rotate into safe haven assets. And the most trusted safe haven on the planet, for thousands of years, has been gold. Now, let's talk about the forecasts, because this is where it gets really interesting. and where the disagreements are genuinely fascinating. Goldman Sachs is targeting $5,400 by end of year. That's a relatively conservative call, but Goldman has a reputation for being measured in its commodity forecasts. So when they say $5,400, the market pays attention. They see continued central bank demand, ETF inflows, and a weak dollar environment as the core catalysts. JP Morgan is more aggressive. They're projecting a $5,055 average through Q4 2026, but their bull case stretches all the way to $6,300. That bull case is predicated on a scenario where the Fed cuts rates multiple times, the dollar weakens significantly further, and geopolitical tension escalates. If those conditions align, JP Morgan's analysts believe gold could run to levels that would have seemed unthinkable just 2 years ago. Wells Fargo is sitting at $6,100 to $6,300 as their target range. That's among the most bullish calls from a major institution. Wells sees the combination of rate cuts, dollar weakness, and record central bank purchases as a powerful enough tailwind to push gold well above its January 2026 peak. Bank of America takes it even further in their most optimistic scenario, $6,350 by Q4 2026. They're essentially saying that if the macroeconomic conditions that have driven gold this year continue to intensify, $6,300 is not just possible, it could be conservative. On the more cautious end, RBC Capital Markets is projecting an average of $4,600 for the year, rising to $4,800 by year end. Standard Chartered is at $4,300 for the next 3 months. Heraeus sees a range of $3,750 to $5,000. These more conservative forecasts reflect the view that gold has run too far too fast, that a Fed holding rates firm will put a ceiling on prices, and that some of the panic-driven buying will fade. What's striking is the enormous spread between the bears and the bulls. We're talking about a difference of well over $2,000 between the most optimistic and most pessimistic forecasts. That tells you something important. Gold right now is a high-conviction asset. The bulls are very bullish. The bears are genuinely skeptical. There's no middle of the road. The technical picture. What the charts are telling us. For the traders watching, let's look at the technical setup, because this is equally important when it comes to timing. Gold is currently hovering around $5,296. The key support levels below us are $5,153, then $5,107, then $5,052, and below that, $4,996. These are the levels where buyers have historically stepped in. If gold starts to pull back, these are the floors you want to watch. On the upside, resistance sits at $5,320, then $5,426, then $5,490, and ultimately, the major resistance zone at $5,608, which is just above the all-time high of $5,595. Breaking through that zone with volume would be a very significant signal that the next leg higher is underway. The RSI, the Relative Strength Index, is currently sitting near 56. That puts us squarely in neutral territory. It's not overbought, which was the situation back in January when the price spiked to $5,595. And it's not oversold either. Neutral RSI in the context of an uptrend typically means the market has room to move in either direction, but the trend remains the deciding factor. The MACD is currently moving sideways in slightly negative territory. That's a consolidation signal, not a reversal signal. It tells us that gold is taking a breath after its explosive run, digesting gains, building a base, before the next directional move. The VWAP and the 20-day simple moving average are both trading very close to the current price, which reinforces the consolidation narrative. For the week ahead, technical analysts are projecting gold to hold a range of roughly $5,107 to $5,208 before making its next decisive move. That makes the current price of $5,296 a short-term breakout above that projected range, a potentially bullish sign if it holds. Now, I'm not in the business of just painting rosy pictures. Let's be real about what could derail this rally, because there are genuine risks here. The biggest risk to gold right now is the Federal Reserve. As of today, 98% of market participants expect the Fed to hold rates steady at 3.50 to 3.75%. Only a 2% probability is being assigned to a rate cut at the March meeting. Gold loves low interest rates because it doesn't pay yield. When rates are high, you give up potential income to hold it. If the Fed stays hawkish longer than expected, or worse, signals rate hikes, gold would face significant headwinds. The second risk is the US dollar. Right now it's weak, and that's tailwind for gold. But if US economic data continues to come in stronger than expected, strong jobs numbers, resilient consumer spending, the dollar could strengthen again, putting downward pressure on gold prices. Third, we have to acknowledge the demand side. Jewelry demand, historically one of the largest components of physical gold demand, fell 18% globally in 2025 because prices were simply too high for everyday consumers. In China alone, jewelry demand crashed 24%. If investment demand cools even slightly without jewelry demand stepping back in, the support structure for prices could weaken. And then there's the simple psychology of markets. Gold had a historic blow-off top in January. It crashed 9% in a single day. That kind of violent correction leaves scars. Some investors who bought near the highs are still sitting on losses. They may sell into any rally, creating what technical analysts call overhead resistance, pockets of supply from trapped buyers looking to break even. So where does gold go from here? There are really three scenarios playing out in real time, and which one materializes depends heavily on what the Fed does and how global macro conditions evolve. Scenario 1 is the bull case, and this is the $6,300 path. For this to play out, you need the Fed to cut rates at least 2 to 3 times in 2026, the dollar to continue weakening, central banks to maintain or accelerate their gold purchases, and geopolitical risk to remain elevated. If all of those dominoes fall in the right direction, we could be looking at gold breaking its January all-time high of $5,595, running through the psychological $6,000 level, and potentially reaching the Wells Fargo and JP Morgan bull case targets of $6,100 to $6,300 by year-end. That would represent roughly another 15 to 19% upside from today's price, still enormous potential gains for those positioned correctly. Scenario 2 is the base case, a range-bound consolidation between $4,800 and $5,500 for the next several months. Gold has had an extraordinary run. Markets rarely move in a straight line. A period of sideways chop, where gold digests its gains, shakes out weak hands, and rebuilds a stronger foundation, would actually be healthy. This is where Goldman Sachs sits with their $5,400 end-of-year target. It's constructive, it's bullish, but it doesn't involve the fireworks of new all-time highs in the near term. Scenario 3 is the bear case, a deeper correction back toward $4,000 to $4,400. This would require the Fed to signal a prolonged pause or even a hawkish pivot, the dollar to strengthen meaningfully, and investor sentiment to sour on risk assets broadly. This is RBC's and Standard Chartered's territory. It's the minority view among major institutions right now, but it's not impossible. And if you're trading gold rather than holding it long-term, this is the scenario you need to have a plan for. When you weigh the evidence, central bank demand at record levels, ETF inflows accelerating, macro tailwinds from a weak dollar and geopolitical tension, and forecast upgrades from the biggest banks in the world, the balance of probabilities tilts meaningfully toward the bull case, with the base case as a realistic alternative. The bear case would require a significant reversal in macroeconomic conditions that are not currently showing signs of turning. Let me bring this home with something practical. If you're an investor trying to figure out what to do with this information, here's the way to think about it. Gold at $5,296 is expensive relative to where it was a year ago. But expensive and overvalued are not the same thing. When the fundamental drivers of an asset, central bank demand, currency dynamics, geopolitical risk, debt concerns, are all pointing in the same direction and are structural rather than speculative, what looks expensive today can look cheap in hindsight 12 months from now. The forecast for March 2026 specifically puts gold in a range of $5,078 to $6,234, with an average of $5,517 and a month-end target of $5,459. The short-term 7-day algorithm is pointing to $5,312. These aren't guarantees, no forecast ever is, but they give you a framework for understanding what the data and the models are saying. The gold market in 2026 is not a simple story of fear and panic buying. It is a sophisticated, institution-led reallocation of capital driven by real structural concerns about currency credibility, fiscal sustainability, and global stability. The banks that are calling for $6,300 are not making emotional bets. They're running models and reading signals that suggest this move is not over. Whether gold hits $6,300, consolidates at $5,500, or pulls back to $4,400, the one thing that's clear is that gold has firmly re-established itself as the world's premier safe haven asset at a moment when the world needs safe havens more than it has in decades. If you found this breakdown valuable, hit that subscribe button. We drop fresh market analysis every week. And drop a comment below. Do you think gold hits $6,300 before the end of 2026? Let's hear your take.